Very good evening, everyone. As usual, we are coming every day with one unique insight. We are doing a learning series for 21 days, coming up with 21 insights on different strategies. Throughout the year, we work hard and we build our wealth. We work towards building our wealth. But if we don't plan it appropriately, we might be ending up with a lot of leakages in taxes. Today's topic is exclusively on real estate tax moves. If you are a real estate investor or you're a flipper or developer, definitely the next 10 minutes would be a good value addition for you. If you are a real estate investor, the first and most important, look into your last year tax return. Identify how much taxes you had paid on your real estate rental properties. If you are paying some extra taxes on your rental income after claiming all your expenses, I want you to consider cost segregation this year. The cost segregation is an exclusive study which allows you to claim more depreciated, accelerated depreciation against your rental income. This could help you to bring down your taxable income on your passive rental incomes. This is about that, and you also look into that. Are you optimizing are all allowed expenses against your rental income? It could be property management fee, repairs and maintenance, or some travel related, or many maintenance expenses, labor expenses, anything. So review, look into that. What are the expenses you can claim against your rental property income, and you can optimize all your expenses. At the end, your objective should be not to pay a lot of taxes on your rental income. Number two, for the real estate property, if you are a big real estate investor and if you have any capital gains this year, you have multiple options on optimizing your capital gain taxes. Number one, 1031 exchange. It's a 1031 exchange is where you invest the entire sale proceeds to buy a similar property in the next 180 days. There are some rules are available applicable, but you can defer your capital gain tax liability to the future period. It could be long term capital gain or it could be short term capital gain. And the third important point is adjusting your rental losses with your W2 income. In general, we have W2 income or business income, which is an active. Any income or loss from the real estate is a passive. They cannot, they don't like each other. They are like this. You cannot adjust your incomes versus losses. But if you have rental property which is a short term rentals, that means you assume you have given the property for an Airbnb. So Airbnb tenants, so where the tenant is staying for average less than 7 days, and if you have such property, then it is considered as an active business operation rather than passive. In that case, if you are getting any depreciation, those depreciation will directly adjust with your W2 income or business income. So active and active can combine, but active and passive cannot. So if you are having any short-term rentals, definitely it's an opportunity for you to optimize your taxes. And if you have any properties you bought recently, still you have time. As long as you can demonstrate that you spent more than 100 number of hours on these short-term rental losses, short-term rental properties. And if you have any capital gains this year from the sale of your real estate property, you can offset these capital gains with any capital losses even from the stock market. In stock market today, it is very market this year stock market is very much volatile. If you have seen any stocks which are in red color, it could be an opportunity for you to sell those stock and book those capital losses. These capital losses can be adjusted with your capital gains from the which have come from your real estate property sale or from any other capital gains on the sale, maybe from the sale of stock market. So that is also very important strategy which you should consider. Then then if you are and prepay your property expenses. So when you have a real estate property, you have some standard expenses like insurance, HOA dues, maintenance contracts, or professional services, property management fee. You have an option to prepay those expenses before December 31st, which are supposed to be paid next year. You can do the prepay of expenses and you can claim those as a deductions for this year, so that you are pushing your tax liability to the future period. And whatever expenses you are incurring this year, one of the other important thing is you might be able to write off 100%, because under section 179, if you are incurring any expenses, if you are having any property, you are eligible for accelerated depreciation. So you should be able to claim 100% of the value of the property if the value of the if the lifetime of the asset is less than 20 years. So if you are buying any property, you can go for a cost segregation, split the value into multiple age buckets, and you can enjoy the tax savings if as a 100% accelerated depreciation this year against your real estate rental property. So these are the few strategies which you can consider, and definitely you can save a lot of taxes. And the most important, try to meet your an accountant or CPA or an advisor before end of this year without fail, who can help you in optimizing it. If you are meeting your an accountant or CPA yearly one time to file your taxes, definitely you might be missing a lot of money on the table. You need to get in habit of meeting your an accountant or CPA every year at least twice, one at the time of filing taxes, one at the time of planning. Before year end, still a lot of opportunities are there. We have 2 weeks of time for this year end. Definitely during this vacation time, let's spend some time with your an accountant and start saving the money. And thank you very much. Tomorrow again we will catch it up with some we'll catch up again with some new topic.